Why do you think we cannot see a repeat of 1990s or a repeat of 1980s, what we saw in US, where consumer stocks or consumption names, they enjoyed a multi-year bull run before they got topped out?
Well, I'm not saying that they're probably going to peak out anytime soon. And I think that we're already in that multi-year bull market for consumer-oriented names. I think by and large, consumption as a basket from a pure public markets perspective has been outperforming from, say, I think at least 2006 or 2007. We're already about 5 years into this multi-year bull market. Normally bull market cycles for any sector are broadly about 7 to 8 years. If you really look at the big technology boom, it was from, say, 92 to 2000. It was an 8-year cycle. So we're probably already 5 to 6 years into this cycle. It's quite possible that this bull market could last for another 1 or 2 years in the consumption space. But will it come to some kind of a stop at some stage? I would tend to think so. From a valuation point of view, would these companies be around 10 years, 20 years, 30 years down the line? Surely, yes. I think most of the names that we talked about, I think a lot of these companies would be around 1 or 2 decades down the line. But would the valuations of 40, 50 times sustain? I don't think so.
So if your big sell call for FY13 is to sell some of these consumer names, what is your big buy call?
No, first of all, I don't think one would want to sell into these consumption names. As I said, that they may not give you solid absolute returns from here, some of the larger consumer names, but they can still kind of outperform till the investment cycle does not come in. You probably will see price erosion only and only when the investment cycle really picks up, and investors, because today most investors probably are still under-owned the investment space. And I think you'd clearly see flight of capital or reallocation of capital happen from consumption or defensive names into the high beta or the investment oriented names. The question is, when will that happen? So I think we're going to be in very interesting times over the next 3 to 4 quarters, where you'd probably have to very carefully allocate incremental capital to basically tier 2 consumption names, which are still not at those 30, 40, 50p multiples, but probably are between the 10 to 20p multiple range. I still think that it's still time to allocate capital to those kind of names and continuously keep evaluating a lot of the investment cycle oriented names, the capex oriented names, the engineering oriented names. Maybe it's still a little early to allocate capital there, but I think you'd still very clearly need to have them on your radar.
If Hero MotoCorp was your top large cap idea for FY12, what is your top large cap idea for FY13?
Well, I think that probably from a very contrarian perspective, it could still be names like, Infosys or Reliance. I mean, these are, of course, both as companies, they have not reported good fundamental performance. And as stocks, of course, they have clearly disappointed over the last couple of quarters. And so from that perspective, given that some of the defensive names have already kind of gone into that 35, 40, 45p multiple range, I still think that it's quite possible that names like Infosys or Reliance have a good chance to basically outperform in FY13, given that the expectations from them are extremely low. I think the expectations from them are so low that today when these companies like them give a guidance, I think analysts are basically, actually putting their estimates below the guidance numbers. And if I think these companies basically come out and say that no, the next 1 or 2 quarters are going to be good, I think there's a strong chance for them to outperform.
Reliance and Infosys, they have one feature which is common, which is they both are dependent on global growth. So are you betting on global recovery for the second half?
Well, I think, as we said, that within the global economy, the US seems to be doing a lot better than expectations. So I still think that you're probably going to have a world where the US will do relatively better, while the rest of the world may not do as well. For IT companies, still US continues to be a very big market, and therefore I think the ability for US as a market from technology spending to positively surprise, I still think the potential could be there. And then again, I think it's a question of valuations. I think these companies now are trading at 14, 15 times valuations. There's no real premium, there is no froth, expectations are very low, and I think just 1 quarter and you could see actually the outperformance coming in.
I've been told that for FY12 your fund was one of the best performing fund in India, so my compliments for that. But for FY13, how are you planning to differentiate?
Well, I think in FY13 we intend to be a lot more aggressive.
Which is you'll be buying more?
Yes, I think.
What's on your radar?
Well, as I said, that I think the Clearly what is on our radar are basically consumption, within consumption.
Don't spill your beans. Give us some names.
No, I don't
what
think.
Do you like?
No, I don't think we can. I think at this stage get stock specific. But I clearly think that a lot of value is emerging in some of the discretionary spending areas. So companies which are basically into, again, consumer durables and are not into products which are of daily use. But I think there we've seen some kind of slowdown in demand. But we think that that's not something which is permanent. We think demand will come back. So I think that's one area that we're really focused on. Two is I think we continue to evaluate tier 2 private sector banks. We clearly think that, again, the top private sector banks are quoting at virtually 3 times price to book. We think that probably a lot of the tier 2 private sector banks are quoting between 1 to 1.5 times.
The old
price
ones
to
or the new ones? Which ones do you like?
I think the old ones. All the new ones probably are trading already at those, 3 times. And we think that clearly a lot of capital could get allocated from the NBFC space, given what really has happened on a regulatory front over the last few weeks. I think we could see a lot of capital get into some of those private sector banks, the old private sector banks.
So let me guess the basket. Something like a Karuvesa Bank, Federal Bank, or maybe a Karnataka Bank. That's the basket you like.
Yeah, I think these are some of the kind of, that's the space you're evaluating, and you're taking a much harder look. And we clearly think that, the current financial year, I think, is going to offer us a fantastic entry opportunity into some of these businesses.
Where have you taken a deep dive for FY13 already?
Well, I think the deep dive is more in terms of research, and I think that deep dive continues in sectors which I mentioned. Again, I think the agri space, some of the bellwethers in the agri space, it's quite possible that FY13 might end up being a flat year for them. FY12, particularly the second half of FY12, was not particularly good for them. FY13, we expect that even the first half may not be, again, very good for them. But I think that's probably going to make valuations attractive, and I think that's going to create an entry opportunity, because we clearly think that agriculture as an opportunity from an India point of view cannot be ignored. We think over the next 3 to 5 years, the opportunity in agriculture, particularly agri-input space, is significant. I think it's going to be a very meaningful opportunity. And I think if the markets do present an attractive opportunity, again, that's a space we are very keenly interested in.
Are you hot on global commodities?
Not anymore. Clearly believe that by and large, commodities have had a fantastic time. The way emerging markets did have a fantastic time between 2002 and 2007. It's quite possible that commodities, I think they've had a fair share of their run, especially in an environment where, and let's look at over the next 2 or 3 years what could happen. Global demand will still continue to be flattish to tepid, number one. Number two is China is going to land, whether it's going to be a hard landing or a soft landing, but China is landing, which has been really the big origin of demand. Three is interest rates are not going to remain low forever. If at all, from a 3 to 5 year perspective, the probability of interest rates inching higher from a global perspective, not an India perspective, is much higher. And if the US does better, then the dollar has a strong chance to come back. So if you really look at all of these things happening, and if you see a confluence of all these things happening over the next few years, then it's unlikely that commodities will keep rallying the way they have rallied over the last 5 to 10 years.
But at a time when you expect that central banks are likely to follow a loose monetary policy, and they will print money, and they will print more money, and they will print more money after that, why shy away from high beta and especially commodities?
Well, I think that's something which is already already there, in the sense that the US Fed has already given a guidance saying is that till 2013, 2014, they continue to have an accommodative monetary policy. So that's something which the street already knows. And if you look at LTRO1, LTRO2, both have happened at the start of the year. But have commodities made a new high? The answer is no. If at all, the commodities have not been able to, including oil, which has been doing so well, but still oil is nowhere close to where it was in 2007 or 2008. Gold, silver, essentially are all off between 10 to 25% of their highs that they made in 2010 or 2011. So I still think that even if global policymakers adopt an accommodative policy, I think that's something which is known. And finally, the underlying growth dynamics will catch up even in the commodity markets. So I think in that kind of an environment where we know that you're going to have a loose monetary policy, it's very unlikely that commodities are going to still repeat their stellar performance of what they have done over the last 5 to 10 years.
The acronym which bothered us last year was PIGS. The acronym which is bothering us this year is GAR. How important is that, and do you think markets are looking beyond the GAR issue?
No, I think GAR is extremely important.
So it still has potential to spook the market?
It has potential to. I again think that in the short term it's an important event which can play a very important role, basically in taking the markets out of this range that it has seen over the last few weeks. And I think any positive clarification on that is likely to have a very positive impact on the markets in the short term.
Are you of the view that this year, if you get the stock right, irrespective of global macro, local micro, fiscal situation, rupee dollar equation, individual stocks, they will still make money?
Oh, absolutely. I clearly believe that in this financial year probably will be the last financial year of basically flattish earnings, or where earnings growth is not more than 15-20%. It's very unlikely that this situation will remain. I actually believe that over the next 3 to 5 years, I think a lot of positive things can happen which will basically ensure that earnings growth will come back into double digits post this financial year. And I think the way markets do work in advance, it's quite possible that I think if you buy really good quality stocks, irrespective of their size, they could be large caps, mid cap or small cap, and if you buy them at very attractive valuations and take that 3 to 5 year view, I think the chances for creating wealth, I think, are significant. The probability of creating wealth, again, I would say is very high.
So let me ask you a very simple question. What are your money-making ideas for FY13?
No, I think the money-making ideas are, again, as I said, is that from a space, as I said, I think it's going to be consumer, agriculture and financial services.
Since you mentioned that it's important to remain stock-specific for FY13, I'm insisting on that question again.
No, as I said, that I think from the larger names, maybe I think Reliance, Infosys, these are some of the stocks which have underperformed terribly. I think from a
anything
1 to 2 year
outside
perspective.
Nifty 50 which you can share with us, where you think the visibility or the earnings growth is reasonable?
I clearly think that outside the Nifty 50, maybe one sector which I didn't mention is basically the auto component space. I clearly believe that automobile as an opportunity, again, I think is a very durable opportunity. Within that, I think within the auto component space, a lot of companies are trading at single-digit P multiples, and a lot of them have reasonable size. That's one interesting opportunity one can witness, because I think a lot of our auto component companies are not selling components to just the global OEMs for their India facilities, but I think they could get meaningful traction by being vendors to their global facilities. And I think from that perspective, I think it's a very interesting opportunity outside the Nifty 50.
Let me take the clock back. When we had a similar interaction right at the beginning of FY12, you were nervous, you were tentative. For FY13, are you reasonably confident, and do you think this year you would like to approach this market with an aggressive stance?
Yeah, I'd say that cautious aggression or cautious optimism, I clearly think that's basically going to be our stand.